Okay, well, welcome everybody to this seminar, which is on personal tax planning. My name's Sam, and together with my colleague Adam, we run the private client department at Claritas Tax. And we just wanted to share with you some tips and tricks before the end of the tax year on the 5th of April. Just before we start, a few housekeeping rules. You all have your cameras off and we can't see you, so feel free to do whatever you like while you're watching. Your microphones are off as well, but if you would like to ask some questions, there is a Q&A function at the bottom of your screen. If you could type those in there and send them, then we'll collate those and hopefully we'll answer those at the end. If we do run out of time, hopefully we can contact those people whose questions haven't been answered and get back to you. So just a little bit about us. This Claritas Tax, hopefully most of you know us already by now. This is just a snapshot of some of the things that we did in the last year, because we're very proud of it and all the things that we've done. We won 4 great awards, which was fantastic, but we've also done lots and lots of exciting work for our clients. So hopefully we'll see you again. So today we're going to talk to you, as I said, about end of year tax planning tips. If we could move to the next slide, Talia. So my name's Sam, I'm an associate partner and I head up the private client team. I've been working in private client tax for over 25 years now, which makes me sound very, very old indeed. But my background is in high net worth individuals. So I cover the broad range of taxes, including IHT, income tax, capital gains tax, and my personal favourite is trusts. So I'm going to hand over to Adam now, who'll do a bit of an introduction to himself, and then we'll get going. And as I said, if you have any questions, please do jot them down and we'll get to them at the end.
Thanks, Sam. Yeah, hi, everybody. As Sam said, I'm Adam Keats. I've been working in tax for just over 10 years now, predominantly in private clients. I also do a bit of transactional work as well. I specialise mainly in owner-managed businesses and the personal tax implications for their owners. So predominantly capital gains tax and inheritance tax. I've been with Claritas for coming up for 6 years now, and working with Sam in the private client department predominantly. So introduction's done. Let's get started, please, Talia. And I will talk a little bit about upcoming changes to tax rates and thresholds from the end of the 2022-23 tax year, which will end on the 5th of April. So any new changes here apply from the 6th of April onwards. So I'm sure everyone's aware that we had quite a turbulent year last year in terms of government tax policy. After the revolving door of Chancellor stopped spinning, we landed with Jeremy Hunt, and in his autumn statements, he set out a few cuts to tax allowances and changes to tax thresholds, which will have an impact for income tax and capital gains tax purposes. The general objective being to increase the tax take by freezing or reducing allowances and thresholds, and as more people are pushed into higher income brackets by inflation, the tax take will increase. So starting with income tax, from the 6th of April, the additional rate of income tax will be reduced from £150,000 down to £125,140. So that is the level of total income at which the additional rate of tax kicks in. So that's 45% on most income and 39.35% on dividends. So taking an example there of someone who's got a salary of £150,000, they will be subject to about £1,200 extra income tax in 2023-24 as they would be in the current tax year. Dividends, there is a tax-free dividend allowance. That's currently £2,000. It was originally £5,000 a few years ago, and that is being halved down to £1,000 from the 6th of April. So another small example just there. If we have an individual who in the 2022-23 tax year is within the higher rate bracket rather than the additional rate, and then also receives a £10,000 dividend, that dividend's costing them around about £2,700 in income tax with the current rate that they'd be paying at a high rate and the availability of of their allowance. Post 6th of April, a person in an identical position is going to be pushed potentially into the additional rate, so paying tax at a high rate and also with a reduced allowance. So it's going to cost them about an extra £800 to get that same dividend. Moving on to CGT, there is, similar to the dividend allowance, there's an annual capital gains tax exemption. So currently, capital gains in the tax year of £12,300 or less in total are not subject to CGT, they're exempt from CGT. That exemption is being overhalved from 12,300 down to 6,000 from April. So any gains that are crystallised in excess of £6,000 will be subject to CGT, and the main rate of CGT is 20%. It's 28% on some assets like property, and it's 10% if business asset disposal relief is available, or to the extent that the individual hasn't utilised their full basic rate tax band. So what does this mean in terms of tips and tricks, and what can you do before the end of the tax year? I think in terms of the income tax points, it's particularly prevalent for director shareholders and business owners who are in control of the flow of dividends on shares that they own. So accelerating dividends so that they're declared before the new tax year could result in some tax savings. That might also be useful for owners of family investment companies where dividends are split across family members to utilise exemptions and allowances. It'll be more tax efficient to get dividends declared before the new tax year when the rates change. For CGT, it's the halving of that allowance is not likely to be too significant for large business sales and larger transactions. But generally, smaller gains, the overall net proceeds will be more material impact of that reduction of the allowance after the new tax year starts than there would be before. So potentially there's an advantage to be gained there, a material advantage in accelerating the disposal of assets and triggering gains now, rather than wait until the end of the tax year. And just generally speaking as well, lots of people who own investment portfolios, whether they're managed or not, will look to maximise the use of the annual exemption by triggering gains right up to that exemption level before the year end. So just a point to be aware of there, that is changing going forward. So something to keep in mind to stay out of triggering any CGT liabilities. Okay, so I think we can move on from that slide, please, Talia, and Sam will pick up now and talk a little bit about pensions.
Yeah, pensions are, some people love them, some people hate them. But if we're talking about tax mitigation, income tax rates are the highest rates that we have. Capital gains tax rates, currently the maximum is only 20%. Whereas at income tax, we're looking at 45%, 39.35 on dividends. So if there is something we can do with income tax, we should do it because it gives us the greatest scope. Now, pension contributions are a great way to do this. And it's really important to realise that while we can't carry relief back anymore, those of you who are as old as me will remember that we used to be able to carry our pension relief back to earlier years. Can't do that anymore, but what we can do is bring forward allowances that we haven't used. But it's crucial to note that these allowances can only be carried forward for 3 tax years. So 5th of April 2023 is a deadline for bringing forward allowances from 3 years ago. So just to recap some of the key points about pensions before we talk about this, most people have a £40,000 annual allowance, which means that you can contribute £40,000 in gross terms to your pension fund. When I talk about gross terms, what I mean by that is if you make your pension contribution directly from your salary or from salary sacrifice, you're going to be getting your tax relief upfront, so that will be your gross contribution. If you have your money and you pay your own money from your bank account into a pension, you will pay that net of 20% basic rate tax, and the pension fund will reclaim that 20% from the revenue. You can then also get the additional 20% or potentially 25%, depending on what your marginal rate of tax is, tax relief claiming through your tax return. So overall, you'll end up with the same amount of money, but the maximum allowance we have is £40,000. It is important to note, though, that that £40,000 only applies if you haven't accessed your pension fund, depending on how old you are. Clearly, I'm nowhere near old enough pension age, which is unfortunate. If you can access your pension and you have accessed it to a sufficient extent that your annual allowance is actually limited down to £4,000, that's called the money purchase annual allowance. And normally applies if people are in drawdown, flexible drawdown, for example. It doesn't apply to defined benefit schemes, and it doesn't apply if you've just accessed small amounts of small pots. But for the purposes of this, I'm going to assume that we're talking about people who do have this big £40,000 available to potentially contribute into your pension. So, as I said, there's a 3-year carry forward. So currently, we're in the 22-23 tax year, so we can carry forward pension contributions unused amounts from 2019-20 onwards. This means that potentially today, if we hadn't made any pension contributions up to this point, we could potentially pay up to £160,000 into a pension. Clearly, that's a lot of money, and in terms of maximising tax relief, that would be a great way to reduce our income if that's what we wanted to do. It is also important to note, though, that the current year is always used in priority to any carried forward amounts. So if we wanted to put some money in this year, and we didn't want to lose 2019-20's level, because after 5th of April, we're then in the 23-24 tax year, so 2019-20 just gets lost. We would need to pay in £80,000 because we would need to use all of this year's allowance before we even started using the 19-20 allowance. So if we wanted to maximise both of, the amount that we're not going to lose any going forwards, we'd need to do £80,000. Once we're doing that, once we've used the current year, we are going in on a FIFO basis, essentially. So we'd use 2019-20 first, because that would get lost sooner, and continue through 2021 and 21-22. But the key to note here is also that we can only make pension contributions to the extent that we have net relevant earnings. Net relevant earnings isn't the same as income, it is earned income, so it will include amounts received as salary. It will also include other things that are assessed as employment income, which could be share awards and things. It also includes profits from furnished holiday lettings, which are a specific type of letting. Doesn't have to be in a holiday destination. You could have a furnished holiday letting in Birmingham if you wanted, but it does have to fulfill certain criteria of availability and times occupied, and that it's not rented to one person for too long in any given year. So some people that's an issue. If you don't earn £160,000, how can you possibly make £160,000 worth of contributions? But if we've got the position where this is an owner managed business, you can use, if your company, if your employer pays your pension contributions, that is your earnings. So it's not that you need to have additional earnings on top of that. Your employer can pay you £40,000, and that is essentially your earnings that are going straight into pension. So that's really something to think about, particularly where you may have family members who work in the company, provided they genuinely do work in the company. And you do need to be careful that you're not paying them massively excessively, because you may then lose your corporation tax deduction in the company. But it's certainly something to think about if you need to generate that income to make that pension contribution, to look at doing it through the company. Of course, if you do salary sacrifice pension contributions, which is a recognised way of paying pension contributions, you also get the national insurance benefit. Not only do you get your income tax relief at source, but there's also that benefit on national insurance, both for the employee and the employer. So far, so good. We're all going to whack loads of money into our pension funds, but it is important that we need to beware that there is a tapering of the allowance for higher earners. What you may remember a few years ago, the junior doctors who were refusing to do extra work, basically because it would make their income too high and they wouldn't get the pension relief. So a few years ago, the income limits were increased. So there are two numbers that we need to bear in mind. One is 200 and one is £240,000, and that includes pensions contributions. But it is income, it is not earned income. So, you know, some people will say, well, I only draw a £20,000 salary, I'm absolutely fine. Not if you also draw £300,000 worth of dividends. So if your income is at a higher level, we reduce the amount of that £40,000 down by £1 for every £2 above the highest threshold there. The minimum level of pension contributions you can have is £4,000, and that would be reached at £312,000, which is essentially 36,000 times 2 for the reduction to get that level. Key point to note for this year and trying to maximise what we're doing this year before we lose it is in 2019-20, the thresholds were lower. So the thresholds were 110 and 140,000 pounds. So we need to make sure that in that year, if we do have income that's fine for the current threshold levels, that in that year we check the income as well, because if the thresholds are exceeded in that year, then the allowance available for carry forward will also be reduced. Also need to consider when you want to make your pension contributions. You may be one of those people who has used previous year's allowances, so you're not really worried about losing 1920's £40,000, or you may have much more income in these current years than you had in previous years. As Adam was talking about, rates are changing next year, thresholds are changing, and it may be that you want to think about whether it's going to be more beneficial for you to pay a contribution before the 5th of April and have it fall into the 22-23 tax year, or delay until 23-24 to maximise your relief. So you might want to pay it in 22-23 either to use previous year's allowances, or perhaps if your income is higher this year and you want to use your pension contributions to reduce your income down, perhaps below the 150,000 threshold, perhaps below the £100,000 threshold, which is where you start to lose your personal allowance. Similarly, if your income is going to be higher in 23-24, or even if your income is the same and you're one of these people who's being caught by the 45% rate threshold dropping to 125, 140, you may want to do it in 23-24 instead, because you're getting maximum relief on those contributions. Of course, the reason that the 45% rate is dropping to 125, 140 next year is because of the effective 60% rate between 100 and 125, 140, which is where your personal allowance is clawed back, because in a similar way to that, the allowance being reduced by £1 for every 2, to the extent your income exceeds 100,000, your personal allowance is then scaled back by £1 for every 2. And this generally means that where people are hovering around that 125,000 pounds worth of income, that they will try and make additional pension contributions to try and bring their income down, and they're essentially then getting tax relief at 60%. So that's something to think about, and maybe look at your income for this year and your expected income for next year, and work out what's the most beneficial for you. And obviously we can help you with that if that's something you want to consider. The last point I wanted to mention on pensions was stakeholder pensions. Broadly, stakeholder pensions are for people who don't have net relevant earnings. So you can pay £3,600 into a pension with no earnings at all. As I said, if you're paying things out of your own pocket, that's net of basic rate relief at 20%. So the amount you'd pay would be £2,880. Now, why am I telling you this? Because clearly all of you people have lots and lots of lovely income. Well, one thing you could do is start paying into a stakeholder pension for your children, as an example. If you paid £2,880, which would be grossed up to £3,600 into a child's pension, they'd have £65,000 just in contributions by the time they were 18. And by the state pension age, they'd have almost £250,000, and that's with no growth in that over the period of time. So, it could be something to consider if you wanted to do something to provide for your children or for other non-tax-paying people. Just a point to note, though, is that it is still a pension. So if you start paying into a pension for a child now, they potentially can't access that for, almost 60 years. I mean, it's also important to note that you can only access pension funds. It's now statutorily 10 years below the state pension age. And as we've all spotted, the state pension age is going up and up and up. Even in my lifetime, my state pension age has gone up from 60 to 68. And I'm sure that by the time I get there, it'll probably be even higher than that. So it is worth bearing in mind that if you are putting money in there, it is going to be tied up for a long time. It's not that you're going to necessarily be able to access that at an earlier point. So that was all I wanted to say on pension contributions, and I'm going to hand back over to Adam.
Thank you. So yeah, it's a section now on tax favoured investments, and the majority of what we'll talk about here is going to be on venture capital reliefs, which is just an umbrella term really for various different schemes. So the Enterprise Investment Scheme, EIS, the Seed Enterprise Investment Scheme, SEIS, and venture capital trusts, VCTs. So these schemes are government endorsed and HMRC approved. The general idea being to offer tax reliefs to incentivize individuals to invest in smaller companies. They're typically young. They generally be less than 7 years old. Companies which are in high growth phase. The objective being to encourage investment by offsetting some of the risk that would normally be associated in, these are generally higher risk investments into small companies. So the tax relief offsets some of that risk. So how do schemes work? For EIS and SEIS and the VCT as well, it's a straight percentage of the amount invested, which is eligible for tax relief. So it's a straight tax reducer. It's not the same as it is for pensions, whereby you can be obtaining relief at your marginal rate of tax. For EIS, you get income tax relief for 30% of the amount invested. And for SEIS, you get relief for 50% of the amount invested. For VCTs, it's 30% as well. So if you were to invest £100,000 into EIS qualifying investments, you get £30,000 tax deduction. There are limits in the amount you can invest in each year. So it's up to £1 million for EIS and £100,000 for SEIS, £200,000 for VCTs. That SEIS limit will be increasing to 200,000 from 6th of April this year. And there is a separate limit as well for EIS relief and what's known as knowledge intensive companies. So they're typically companies which are involved in research, development and innovation, and you can invest £2 million into those instead of £1 million. There are quite a lot of conditions to be satisfied to be eligible for the reliefs for both the company and the individual, various hoops to jump through and applications to be made to HMRC. Generally speaking, the key points for individuals will be that to be eligible for the relief, for EIS relief, you can't own more than 30% of the company you're investing in, and you can't be an employee or a paid director of the company. There are a couple of small caveats there for the directorship, but generally you can't be an employee or a paid director. So in addition to the income tax relief, there's also an extra advantage there that the tax relief can effectively be claimed in the current year or carried back to the previous year. So it's still possible before the 6th of April 2023 to make these investments, EIS qualifying investments or SEIS qualifying investments, and carry back that relief to the 21-22 tax year, or you can claim it in the current year. And then again, going forward, post 5th of April you'll still be able to claim tax relief in the current tax year, the year to the 5th of April 2023, by any qualifying investments made before the 6th of April 2024. And that election can, that can be made quite flexibly there. It generally can be done through self-assessment as well. So in addition to the income tax relief at source, there's a potential further advantage if the investment were to ever fail in the future. So if this further de-risks what's being invested, generally speaking, a capital loss on a disposal of shares or a company which has gone bust, usually only eligible to offset against other capital gains, but EIS qualifying investments will automatically be eligible for the losses to be offset against income instead of against capital. So taking back to that example again, where we've got a taxpayer who's invested £100,000 in an EIS company. If that company then fails, they've had £30,000 income tax relief on the way in. So there's £70,000 left, which to be relieved. If they're an additional rate taxpayer, they're getting 45% relief on the rest of that. So the way the calculation works out is that broadly they're only risking 38.5p in the pound of every investment made if it were to fail. Obviously, the idea is that it doesn't fail anyway, but it's just further de-risks the investment, which is designed to encourage people to help invest in these companies and boost economic growth. From a capital gains tax perspective, it's worth noting that the EIS or SEI investment, when it's sold, the capital gain will be exempt from CGT as long as income tax relief was claimed on the way in and the investment's been held for at least 3 years. So that gain will be completely exempt from tax. There is also the possibility from a CGT perspective to defer gains which are arising now by investing the proceeds into these investments. So into an EIS investment, any proceeds of a capital gain that are invested are eligible for CGT deferral. So those gains will only come back into charge at the point the EIS shares are sold in the future, and they'd be subject to CGT at the rate in force at that time. So that is just a deferral. It's not an absolute saving, but certainly in terms of liquidity and cash flow, it can be quite popular, quite advantageous. And SEIS works slightly differently. There is an absolute saving on CGT there of reinvested proceeds from capital gains. Half of the amount invested is on the original gain. That'll make that original gain. 50% of it will be exempt from CGT. Generally, you can reinvest up to 3 years post triggering the capital gain, which has been realised, or using proceeds from 1 year previously. And that's generally just how it works. As I said, I think we've had a question on that actually that's come up, so I can just answer that now. Like I said, the gain typically comes back into charge at the point that the EIS shares are sold for in the future. They can also come back into charge in a couple of other circumstances. One would be if the shareholder becomes non-resident, and the other would be if the company becomes non-EIS qualifying in some way. It's probably not something that would please the rest of the EIS investors, so it might not be something, a route worth exploring. Just another point to note on that deferral is that the original gain can be on any kind of asset, the one that you're deferring the proceeds from. It doesn't need to be related to EIS or shares in any way. It can be any sort of capital gain that can be deferred. So that covers off everything in terms of venture capital release. Just one small final point on other tax efficient investments would be to maximise ISAs, so individual savings accounts. These are essentially just tax-free wrappers. They could be cash ISAs or stocks and share portfolio ISAs, where the income arising within them, whether it's interest or dividends, will be exempt from income tax as long as they're held within that wrapper. Each individual can contribute up to £20,000 a year into an ISA, and junior ISAs are also available with working pretty much the same way. There's a limit of £9,000 per child that a parent or guardian can contribute to an ISA each year. So there's an opportunity still to maximise use of those thresholds before the end of the tax year. There's no carry forward there. They are just lost if they're not used in a tax year. In terms of the junior ISAs, the child can control the account when they reach the age of 16, but they can't make any withdrawals until they turn 18. Okay, so that's all I wanted to say about those tax efficient investments. So I think the final section now is for Sam to talk about the budget that's coming up next month.
Yeah. In case you aren't aware, the budget date was announced some time ago as being the 15th of March. Obviously, what can we expect in there? I unfortunately don't earn my living as a fortune teller, so I can't guarantee anything at all is going to happen. But given the interesting time we had in the autumn statement, I think perhaps this budget might be a little bit more interesting than ones we've had in the future. So I'm just going to talk about some of the things we think might come up, some of the things that have been speculated upon, and talk about how I think that might manifest itself if there are to be any changes on that in the budget. So is business asset disposal relief going to, be hit again or finally die this long and lingering death that it's been subjected to by the government? Possibly. The government did a review of reliefs recently, and it was looking very much at what are the purposes of these reliefs. And while entrepreneurs certainly felt that the entrepreneurs relief was supposed to be a reward for them having invested their time, money, blood, sweat and tears in growing a business and then selling it for hopefully a profit in the future. Unfortunately, the government didn't share that perspective, and they saw it very much as an incentive rather than a reward, and that's possibly why the name was changed from Entrepreneurs Relief, although I personally think somebody in the Treasury was having a bit of a chuckle to themselves at renaming it Badge Relief. So we may see the limits reduced even further, although £1 million as it currently stands is not really that generous, so I'm not sure where they can really go with that. Other suggestions that have been floated are that it becomes back in line with something that's related to retirement. Those of you who remember when Entrepreneurs Relief first came in, the government had largely just copied and pasted the old retirement relief rules, bar deleting the age requirement. So it may be that there is, while possibly not an age requirement, because that's probably not suitable in these day and ages, but having to be some kind of bigger withdrawal and ceasing of entrepreneurial activity. Something else that's been suggested, kind of in line with business asset disposal relief, is investors relief, which very little talked about relief. But if you don't qualify for business asset disposal relief and the company isn't EIS qualifying, so the gain would be exempt, as Adam's just said, if you claimed the income tax relief on the way in, then investors relief can be very, very beneficial, and the limit for investors relief is still £10 million. However, it's a very little used relief, and the phrase that it might be rationalised away, that may come to pass. If nobody's using a relief, it's no big skin off anybody's nose to get rid of it, and it looks like you're doing something to get some more tax back in. Are CGT rates going to rise? Who knows? Certainly after COVID, it was very much the suggestion that CGT was the place to go for rate rises because people's incomes were under pressure, and CGT's profits on assets, which is less tugging on the heartstrings, but that didn't really happen, and part of the reason for that really is that CGT just isn't big enough to absorb all of that cost. In terms of tax receipts, CGT is dwarfed by income tax relief, such that you'd only need to make small changes to the rates of income tax. You'd have to make significant changes to the rate of CGT. That said, the Office of Tax Simplification did do a review, and they made a number of recommendations, which included bringing CGT rates in line with income tax rates. Now, that was the headline. They did also say there needed to be some allowance for inflation, and the fact that the value of assets will just increase over time. Currently, we don't have any allowance like we used to have indexation allowance to allow for that. So we are being taxed on actual and inflationary gains, but where the rates are lower, it's less of an issue. If we were to look at equalising those rates, then we'd certainly want to see some kind of allowance for that inflationary gain. Increasing the rates more in line with income tax would also improve the horizontal equity of our tax system. Horizontal equity meaning that the tax rates on different types of income or gains should be similar to prevent those who aren't capable or don't own assets from being penalised for not being in the position to own those assets upon which they can make some gains. Rishi Sunak, back when he was Chancellor, did respond to the Office of Tax Simplification's recommendations. And while he actually didn't say that he wasn't going to do anything to CGT, what he did say that is it would need to be as part of a wholesale review of the CGT system. Now, certainly nobody had had any time in September to do anything like that. We'd had the Queen, we had a new Prime Minister, 17 new chancellors in 3 days. So nobody had had the time to sit down and think about it. They have had the time now, if they wanted to, do something more significant with CGT, and we will have to wait and see. But I don't think anything would certainly happen before 6th of April. CGT rates normally don't change in the tax year. It did happen once, but it's not likely to be before 6th of April. So if we do have things that we could get rid of before the 6th of April, if there is a rise, then we would have some time to do that. Pensions, I spoke about pensions earlier, and the idea of higher rate pensions tax relief being abolished comes up every single year. A bit like dropping the 45% threshold from 150 down to 125 odd. It's a relatively simple thing for them to do and an easy win, because people who aren't high rate taxpayers are less likely to, they'll support this move because they're not benefiting from it. Things like lifetime ISAs, leases, whichever you want to call them, they kind of work as a pseudo pension savings vehicle, but you only get basic rate tax relief on that. Fortunately, I am, hard to believe, I know, too old for a LISA, because you had to be under 40 at the time they were introduced. But for the people who are high rate taxpayers and who can contribute to a pension scheme, that's likely to be more beneficial to them. The lifetime allowance limit is a little over £1 million at the moment, but it's been that way for a number of years, and there have been some murmurings that limit will be uprated in line with inflation. As you know, most of the limits at the moment have just been frozen for years, which is, in itself a stealth tax, because especially in times of high inflation, as we've just seen, earnings and everything else going up, but limits staying the same means that more and more people will be falling into those higher rate limits. In terms of pensions, though, when the limits were originally introduced, we hadn't had such big limits on contributions. So at the moment, people contributing to pensions are getting nibbled from both ends. You're limited how much you can put in, you're limited how much you can hold in it. So perhaps there will be a little bit more flexibility in one or the other coming up. But again, we'll have to wait and see. Withdrawal or amendments of other reliefs, we've seen the revenue clamping down very much on research and development reliefs, and there were some changes made back in the autumn to tighten those reliefs and make it a little bit more UK focused. Again, this is back down to the review of reliefs, and basically they're trying to justify why those reliefs are there and what they're for. And the tightening of R&D was very much to get rid of spurious claims of people claiming researching on what daffodils smell like, but also to encourage research and investment in this country, because that's a way of stimulating the economy here. So basically, unless a relief is achieving something that the government wants it to achieve, or it's fixing an unfairness in the system, some of those may be under review. Talking about reliefs, and going back to CGT for a minute, if we were all in a room together, I would ask you if you knew what the single biggest by far CGT relief was. And as I can't hear you all, I'm just going to assume you all got the answer correctly. And that is, of course, principal private residence relief. Now, this is, when you sell your home, that gain is exempt from tax, provided you've lived in it the whole time. There have been some tweaks to it over the years, and in particular, the period of time at the end that you have to sell it once you've moved out has been dramatically shortened from 36 months down to 18, and now just to 9 months. But PPR is still there, but it is by far the biggest CGT relief. And while it would be perhaps a little bit controversial, scrapping that relief would certainly boost the Treasury's coffers at a time when they want some money in. And you could argue that it's unfair because people who can't afford to buy their own house don't have the benefit of then getting a tax-free gain when they sell their house. So, I'm not saying it's going to happen, but it's a possibility. Another relief that's often talked about, particularly in conjunction with CGT, is the position that if you own a business and you die, you'll hopefully get business property relief from IHT on that value, but you also get a tax-free uplift for CGT on death. So there's been some suggestion that possibly one or the other of those would be amended so that you're not getting a double benefit. Again, that's politically easy to spin. We're just giving you one or the other, not both. Why would you want both? That's not fair. But it does potentially lead to distortion in terms of business. If you know you're going to not pay any IHT when you die and you'll get a CGT tax-free uplift on your business, perhaps you will, when you're a bit older, hold on to it until you die in the hope of getting both of those reliefs. So perhaps by getting rid of one of those, that might stimulate the market. The 2022 autumn statement, as you've said, was a little bit of a car crash, but I think tax cuts are unlikely at the moment. But what I also think is likely to happen is that, much like when Rishi Sunak made some more announcements, that you might find things will be leaked to the press, only because the dramatic effects on things, particularly like the bond market and pensions after the Liz Quasi episode, has made people a little bit wary of, announcing things without getting a little bit of a feel for how it's going to go down. So I reckon in the next couple of weeks we'll hear some whispers, and those whispers are likely to probably have some truth in them. One thing that has been talked about a lot recently is non-doms. Obviously ironic for Rishi. And I think it is important to note that while the non-dom regime has always been unpopular, it does encourage wealthy individuals into the UK. Certainly, we see it in our line of work a lot. And it is very much a balance between, closing a loophole that people find unpopular and actually making the UK less attractive. They're already talking about that the 25% corporation tax rate that applies from April is going to make the UK less attractive. So we don't want to make the UK any less attractive, given we can't even get tomatoes to come to the UK at the moment. Last point, wealth taxes and IHT. Back when Rishi was Chancellor and he said he's probably not going to change CGT, he actually did say he wasn't going to change IHT. He was categoric on that. Now, of course, he can change his mind. He's not Chancellor anymore. He's Prime Minister. But I'm not sure there's a massive appetite for changing IHT at the moment. It's an unpopular tax, but again, the freezing of the limits, back since 2008 on the nil rate band has meant that so much more tax is being collected. I think the latest figures show that the last year's IHT take was up significantly, is showing that, even doing nothing, IHT is getting more and more tax in. As far as wealth taxes are concerned, you know, we've got a Conservative government, wealth tax is probably unlikely, but it is still around. It is still, people are still talking about it a little bit. The problem is that, you know, other countries that have tried to introduce a wealth tax haven't been super successful. And also the latest thinking was that if it was a one-off wealth tax, that would be fine. And we just, you know, a bit like paying for the war, we'd have a one-off wealth tax, get a load of money in, pay for COVID, sort everything out, and then we'd be fine. But I think the reality is that people, A, wouldn't believe that it would just be a one-off, and B, any government who, you know, found that successful is likely to use it again. So do I think wealth taxes are going to be a thing? Probably not, but it's just, you know, another one of those things that's around. So those are the things that I think will happen. But the budget is 15th of March, doesn't give us a lot of time before the end of the tax year. But I would also say that in 2020, on the 10th of March, when the Chancellor decimated the business asset disposal relief, there were also anti-forestalling provisions in there. So, you know, basically to try and stop people either hedging their bets or doing things at the last minute just to do things. So at this point, maybe it's a wait and see. And then if we've got some time afterwards, we can do something. I mean, let's be honest, if you decide today that you want to sell your business before the end of the tax year, that might be a bit of a big ask. But, you know, if you've got some assets or shares or possibly even property that you wanted to sell, maybe that could be achievable, but we'll have to wait and see. And obviously you can tune into our budget updates, which will clearly be the best around. So yeah, does anybody have any questions? We've had a couple in, and I think Adam answered one of them, and I think Talia's going to ask the questions for us, if that's okay, Talia.
Yes, of course. So the first one has been answered by Adam, so I'm going to move on to the second one. It says, if a client makes a 1 million cap gain, what are best options in terms of SEIS and EIS?
Yeah, lots of interest in the venture capital reliefs here in the questions, which is good. I mean, the best options in terms of SEIS and EIS are, you know, that whole £1 million capital gain could be deferred in a single tax year through making EIS investments up to that limit. Obviously, as I've said previously, they will come back into charge in the future, so it is just a deferral. There's a potential in the future that the CGT rate might be higher. So particularly if that gain qualifies for business asset disposal relief now, a lot of people might take the view of banking the 10% rate of tax could be the most sensible course of action in terms of purely making EIS investments. Obviously, we're not investment advisors. We're not regulated to provide that kind of advice. I'm sure there are lots of wealth managers out there who focus on EIS and SEIS qualifying investments to be able to advise on spreading the risk or whatever it might be. But it would be possible to fully defer all of that capital gain. I don't know if you have anything else to add there, Sam.
No, that's exactly what I would have said.
Thanks, Adam. Another one here. Can you carry forward income tax loss relief on an EIS loss? For example, an EIS investment that has been liquidated with no proceeds, if you have insufficient income in the year of the loss to take advantage of the income tax relief. Sorry, that's a very long one.
So yeah, that goes back to what I was discussing earlier around getting income tax relief on the way in, but then if the business fails, you can still offset the capital loss against income on the remainder of the investment that's not yet been relieved. That is available on a current year or carry back basis. So you can carry it back 1 year, or you can relieve it in the current year, i.e. the year the investment is made. But there's no facility there to carry that forward.
That's right. I mean, are there any other questions, Talia?
Yes. So does the annual allowance for pensions have any effect on the lifetime allowance?
No, I mean the annual allowance is £40,000 per year, and that's a fixed amount. You know, unless it's adjusted by the income going over the threshold. The lifetime allowance is also a set figure, as I say, it's £1,073,100 at the moment, I think. And that was the thing that I said, they may increase that. But I think if people are putting £40,000 into pension every year for 40 years, potentially they might get to the lifetime allowance very quickly. So it's while there isn't at the moment an interaction between the two, as I said, at the moment you're getting it from both ends. So perhaps one will be changed or the other, but no, that they have no relation to each other as you go along. It's just whether you can contribute as much into your pension.
You may have answered this, Sam, but is the £40,000 pension contribution inclusive of both employers and employees' contribution?
Yes, it is. That £40,000 is essentially the amount going into your pension. So yes, if your employer contributes, that will count towards the £40,000, or if you contribute, the overall limit is £40,000 per year, subject to any carry forward of allowances we talked about.
Lovely, thank you. And a couple more. Can I sell some shares and buy them back immediately to increase my CGT base costs and make use of my higher allowance this year?
It's very clever thinking, and something that presumably people used to do quite a lot because the HMRC cottoned on and shut that down. So there's something called the bed and breakfasting rules now, which basically mean that if you sell shares and then immediately buy them back within 30 days of that disposal, the capital gain, the base cost for capital gains tax purposes is matched from the reacquired shares rather than the original base cost when they were first bought. So that would prevent you from taking advantage of the rules that way and increasing your base cost for a future sale. So unfortunately, that doesn't work.
It doesn't work, but there are a couple of other things you could do. You could sell them and buy them back in your ISA. You could sell shares and convince your spouse to buy them back. Or something people used to do is sectors. So if you sell a banking share, you buy another banking share. I mean, they're only worth pennies at the moment, so why wouldn't you? There are similar ways in which you can try and maximise, but you can't, as Adam said, you can't do bed and breakfasting anymore because that was cottoned on to quite a long time ago.
There's one more. Can my wife and I each own 25% of shares with the 30% limit on an EIS investment?
The short answer is no. There are specific rules in relation to that connection test in terms of what you can own, and that 30% limit. For those purposes, your spouse or parents or children will be treated as connected, so the shareholdings will be aggregated. So you and your wife owning, your spouse owning 25% each would take you over the threshold.
Lovely. Oh, one more has just popped through. Sorry, guys. If pension contribution are deducted from gross salary for tax, is relief effectively given at highest tax rate and not just at a basic rate?
Normally, yes. If it's deducted from your gross salary and it just goes into your pension scheme, yes. There are some circumstances we've seen where the employer only operates a nest scheme, and that's generally where most of the employees are basic rate taxpayers. And under those circumstances, you only get basic rate relief, because the nest system can only work with basic rate relief. So in those circumstances, if you've only had 20% relief on your contributions, you can then claim the remaining 20 or 25% through a tax return, or if you don't complete a tax return, you can do it through your personal gateway account with the revenue and just have it included in your notice of coding. But generally, yes, but not if it's a nest scheme. Okay. I was expecting somebody to say something then, but you're all on mute. I think if is that all of the questions now, Talia?
That's all the questions, yes.
Okay, so I think that's almost perfect timing. You've just got enough time to have a cup of coffee and a comfort break before starting back at 2 o'clock. So thank you all for coming. If you do have any additional questions, please do feel free to drop me or Adam a line, or just contact your normal Claritas contact. And we hope to see you at one of our webinars in future. Thanks very much.
Thank you.